This is Risky Business, and you're watching the Stock Market Brief Show. My name is Michael Silva. We got a lot to discuss on today's episode. Let me tell you, risk can happen fast, and you probably saw it on that NFP report. The Non Farm Payrolls came out better than expected by a wide margin. Woo! I guess Biden is right about the recession not being here. I just don't see it. But if you dig into the report, well, there's always bad things you can pull from it. 71,000 fewer people are working full-time jobs. 92,000 more people working multiple jobs. That's fun. So when you put all this together, you have an economy with high inflation. The stock market's obviously down. Interest rates are up and continuing to go up. And GDP is sagging. Nothing to worry about, folks. So what did the Fed watch tool do? Is the Fed probability of raising heights increasing? Well, this was about 50-50 just last week or 2 weeks ago. And as you can see when the NFP report came out, going for a 50 basis point hike, probability is now 32%. 75 basis point hike is now 68%. So more leaning towards a higher increase in the rate hike. And we have inflation data coming out on August 10th, and that's going to be an important one to watch. Consensus is saying 8.7%. The forecast for trade and economics is 9.1. The previous report was 9.1%. If it's 9.1 this time, it's the market is going to just rumble. Actually, pretty much any report, the market can honestly rumble. We'll see how the market digests this information when it comes. But when that NFP report came out, do not ignore what took place. We're looking at E-mini S&P 500 on a 1 minute time frame just to give you an idea of the velocity of what happens and how fast it can happen. This is a one candle move, right? This is about, it's dropped the market 0.77%, I believe it was, in a single minute. So volatility, when it comes, it can come hard and fast. And as we know, what took place after that, well, we started selling off significantly, and then we bounced back, everything's fine, and then we sold off, oh, what's going on? And we just ping-ponged around. So not that much, to be quite honest. The market's quite resilient right now, to be fully transparent, to be fully honest. As you've seen, we've been ripping up higher despite some negative stuff in the marketplace. What took place this week as far as the 11 sectors go, we had technology, communication services, and consumer discretionary up there leading the way, some big dogs. But how are we looking year to date? Year to date, XLE is still up there in the top spot, 34.43%. And the only other one in the green is 5.23%. That is utilities. Then look just a little bit deeper. Consumer staples in the third spot and XLV in the top 4 spots. Why am I pointing this out year to date? Well, if you take a look at the rotation model of both the stock market, which is orange, and the business cycle that is in blue, you can see here when you're at the top of a stock market peak, you have typically energy performing the best. And as you start making that turn, consumer staples, utilities, and healthcare start to perform. Okay, and then you start moving into early recession, and then you start moving down that business cycle. And as you know that I just pointed out, well, XLE is the leader. XLU, XLP, XLV are in the other spots right there. If we look at a rotation graph on a shorter time period, we're looking at 3-week tail. Okay, so if you look at XLE, right, you got 1, 2, 3 weeks of a tail length, and the longer it is, it means more powerful of a move, and also the thickness of the tail. So XLE is moving into that weakening quadrant. On the shorter time frame, you have XLK, very small tail length, but it is improving, and XLY, a big move also into the improving quadrant, and then the other ones are kind of moving out. However, if you scope out just a little bit and look at a monthly time frame, okay, we're looking at a half a year to see a bigger picture of what's taking place. You can see XLU, XLP, pretty thick tails and long moves, okay, into that leading quadrant. As also to note is XLY is moving into the lagging quadrant. XLK is weakening, but still pointing in the lagging quadrant area too as well. And XLF is wiggling its little way down into the weakening quadrant. Those are some big ones to pay attention to. Why? Why are those big to pay attention to? Well, because they make up a big portion of the S&P 500. And also to note, yields. Okay, first and foremost, we'll look at the 10 and 2 yield curve. Why are financials moving up? Well, it's hard to say, especially given the context of what the yield curve is doing at this particular point in time. We're negative 41 basis points. It continues to get deeper and deeper into inversion, which leads us to believe, right? 10-year and 3-month will probably be inverted at some point as it's been falling off a cliff here. It's at 25 basis points, so we'll continue to watch and see what develops. If we actually look at the 10-year, looking at the TNX as the proxy, closed at 28.40. That means the 10-year closed at 2.84%. Look at this right here. This is a topping tail. If you remember this chart, the reason why I circled it is because I called it out over here on the weekly time frame when this happened, saying that it could be a reversal type candle. Well, technical analysis works sometimes, right? Helps you manage risk. Well, the market started heading down lower. Now we have a pretty bullish looking candle right here. We had one there too, but that didn't matter. So I'm just calling out we have a little bit of a bullish candle taking place after that NFP report. Because if you look at the flip side of this and you look at TLT, also kind of a little bit of a bearish candle forming, right? And it could be potentially wedging into a bear flag. I'm still looking to go tactically long TLT, BAB, IEF. There's a bunch of different type of bond ETFs, but you got to be very tactical here because if the 10-year yield wants to continue to perpetuate to the upside, obviously it can just slam these even further. If we continue on, the reason why I want to point this out so much on the 10-year yield is because of the relative strength when this starts making moves between XLK and SPY and XLY. Those are the big horsemen, along with financials, which we'll talk about momentarily of where I see that as far as relative strength goes. But I want to call this out. So you can see here the 10-year yield, boom, we rise. We rise. The 10-year yield moved high, and then we had this reversal candle, and we started moving down. What is the relative strength of XLK and XLY doing over SPY? Well, you can see as the 10-year yield was rising, the relative strength of XLK, the mega caps, started performing not as well as the overall S&P 500, and that goes for XLY too. So what happens when it goes down, the 10-year yield? Well, take a look. XLK and SPY started moving up. XLY and SPY, the relative strength started moving up. So it's interesting to note that if this starts perpetuating to the upside or starts breathing a little bit and stops falling, that could tell us that the XLK may start to underperform the SPY as well as the XLY. And those, like I said, once again, make up a huge weight of the S&P 500. So it's something to pay very close attention to from an intermarket perspective. Now, XLF, interestingly enough, likes it when the 10-year yield goes up. But if the 10-year yield goes up and the XLF doesn't, well, why? Well, simply put, the yield curve is deeply inverted. So that's why I would see a little bit more bearish here. But from a relative strength perspective, looking at XLF over SPY on a weekly basis, we've been chopping back and forth here, and we actually just had a weekly crack of this prior area of support. So we'll see here if that continues to give us insight that, hey, we'll start to see the XLF underperform the S&P 500. Potentially, if this is a real breakdown, we could come back down to this, 0.7 marker kind of around there. And if you look at the rate of change on this line, it is pointing straight down too as well. So that indicates that we have some momentum to the downside as on this relative strength line goes. Now, on top of all of that, if we take a look at some BP charts, the financials is overextended via the RSI at 74.51. If you look at the technology BP chart, you can see here it's at 70.44, so it is in overbought territory. If you're new here and you're like, what the hell's that? Don't worry. You can see here when we get a little bit overextended, it's not really the place where you want to start pressing. Okay, it's the time where you want to be patient, watch it digest, and see how it responds getting out of it. So we'll see here what takes place. And then if you look at XLY, this is the consumer discretionary bullish percent index. You can see that it's not nearly overextended. It's at 61.21, so it's been coming off a little bit there, and mainly by we saw Tesla's performance take a big hit the other day. Another big thing to watch is the dollar. The dollar has a strong negative correlation to multiple assets, all right? One being the S&P 500. You can see the dollar has been flagging or taking a little bit of a breather, and take a look at what the S&P 500 did. It just shot up completely. And take a look over here when the dollar started rising in dramatic fashion. Well, S&P 500 was falling. Okay, so there is a negative correlation there. So if the dollar, a lot of people are calling that this was the top in the dollar, but hey, if they're wrong and the dollar starts squealing back up into a risk-off type environment, or the TLT, right, people start flooding into bonds, that could very well put pressure on the equity markets, okay? So that is something to pay attention to. If we take a look at week-to-date performance, S&P 500 was up 0.36%, so not much movement, although it was volatile throughout the week, didn't go anywhere, right? We talk about weekly expected moves frequently, and we said it's very rare to have 3 occurrences of that, and as you can see here, we did not get outside of that. We actually just kind of traded within the range. We didn't hit the lower or upper, which we'll talk about here momentarily. NDX, the NASDAQ 100, finished up 2%, breaking away from the weekly 5 EMA, just like the S&P 500 did too as well. And then we had the IWM small caps up 1.9%. So some big moves, and we're fully disconnected from the weekly 5 EMA, being one of the most frequently tagged ones. So look for a reconnect here in the near future. This big move is all happening, by the way, on decelerating volatility that is still above 20. You would think that, 1, 2, 3, 4, 5, 6, 7 weeks of decelerating volume of just red, right? We would be under 20. We're not. Okay, so volatility is still technically trending. We have a low, we have a higher low, we have a higher low, we have a higher low, and we still have a higher low. So volatility, man, it could pick up, and it could pick up fast. Okay, so be very mindful of that. VXN, NASDAQ volatility, it's still in the mid-20s, still high, still trending up. And then we have RVX, Russell volatility, still in the mid-20s. So be very well aware of that. Now, there's a big test coming up here, okay? And that big test is what's known as the anchored VWAP, year-to-date anchored VWAP, I should say. So the year-to-date anchored VWAP is just overhead on a lot of these main indexes. So it's going to be a level of interest to pay attention to. It can very well act as a level of resistance. What is this telling us? It says basically based on the average volume, okay, traded on anchoring it from year to date, the typical average traded volume is in the hole, right? So it's below the anchored VWAP. So if we start getting above it, that can create some euphoria even more so, and more people would be, not underwater. The average buyer, based off of the volume, they'll be in the green. And as it stands right now, they're still in the red. Okay, and this can, and we've seen it act as resistance before. That's at 422.64. At the current moment. Ignore the indicator down here. This is actually something that I'm working on. That's something that I coded this weekend, pulled from a bunch of different places. But yeah, I'll just quickly tell you. It's basically saying short term it's bullish, medium term it's neutral, and long term tail is very, very bullish. It's that's based off of 3-4 years of data right there. If we continue on and look at the Qs over the anchored VWAP, you can see we're a lot closer. It's at 327.92 as we've seen this big, strong move up into it. That's where it gets a little, like if we get a little bit more outside of it, it'd be such a strong move, it wouldn't indicate a buy signal to me. I would still need to see what this move looks like during a digestion, consolidation, pullback, or something like that. If we look at the trends here, you have pretty much short term is bullish, no joke there. Medium term, neutral, and then we have the long term, which is way more data still in the blue, which is bullish. And then if you take a look at the IWM, we're not too far off of that anchored VWAP either. Okay, so we're just right there, but it's also coming up into an area where we have a medium-term neutral trend, which could very well put pressure on us. We can see typically when it goes neutral, it could be potentially changing soon. So, it's been bearish, now it's neutral. Short-term is still bullish at this particular point in time, and the long-term is still bullish. If we take a look at the S&P 500, the SPY weekly risk range, we're looking at the SPY is 422.29 to the upside, 404.65 to the downside. We just consolidated, very similar to what we saw right over here. Now we're moving into the CPI report, August 10th. Pay close attention to August 9th into the closing bell, okay? Reason why I'm saying that is because the last CPI report was right here, but towards the closing bell, clearly the data was leaked because the price action just started falling off a rock, and then the market followed through to the downside. So if we get, whiff on, the 9th, and the market starts selling off towards the closing bell, that could indicate that we're probably going to be getting a hot CPI report. Is it going to come in at, below 9.1? A lot of people are calling for peak inflation. That kind of makes sense to me, but understand that still a 9% reading or an 8.9% reading. We'll see how the market interprets that, but that is still high. That is very high, and the Fed will still have to follow its path to increasing rate hikes. So if it comes in at 9.1, who knows? Maybe the markets are going to start flipping and saying it's going to be a 1% rate hike. That's all speculation, okay? So if you don't want to trade into that volatility, don't. And let the market digest it and wait for things to set up. If we take a look at the 65-minute time frame, the S&P 500, Still, price is holding the 5-day moving average, so we're still bullish in the short term here. It is on a negative divergence. It was on a negative divergence there, negative divergence over here, so PMO, RSI, and this has been a very strong move that hasn't really digested yet. We did get below that 5-day moving average, but it just went right into the buy signals, okay? So it just buy. Algo said, buy this dip, and it started ripping up higher, okay? The Qs. Also, they actually tagged their upper weekly risk range last week, and now the weekly risk range we're looking at 331.07 for the upper range, which is right here, and then the lower range is 312.43. 68% of the time it typically lands within this, but the prior weeks, the last two, not this previous week, but the two prior to that, they did close outside of it, and then now we finally tagged the upper, and then we started moving down. Okay, so we'll see how this plays out. If you go to the lower end, that actually matches up with this prior area of resistance, and that could potentially act as a level of support. So we'll see here if the trend wants to continue to the upside. Just be mindful that we do have, like I said, we have that overhead anchored VWAP year-to-date anchor, which could very well be hard to get back over and hold consistently without seeing any sort of digestion or consolidation. So a little bit of a holding period here. If you take a look at the Qs on the 65-minute time frame, we are above the 5-day moving average, which is still inclining. And looky here, we came down, we tested it, and kaboom. And I think on the last episode we said, the bulls are still in control, and they are right now too. If it comes down here, maybe we pull up and then we start bouncing. Well, if you caught that, congratulations. Now, just be very mindful that the 5-day moving average, it's starting to kind of just slow down because price is still very close to it. And when that report comes out, if we get some more movement to the downside, this is going to start to curve over as we lose prior data and new data forms. This can potentially start flattening out to curling over. Very similar to what we saw here. Doesn't mean that we're going to have the same type of drop, but be aware of that and where we stand on that 5-day moving average. If you're on the 65-minute time frame, it's the 30-period moving average. That equals approximately the 5-day moving average. Taking a look at the IWM, the upper risk range here, or the expected move, I should say, 195.76. The lower expected move is 185.84. Okay? Now, not much going on here, to be quite honest. We had a nice big run up. A lot of small caps got squeezed, and now we're pulling into this red line here across the screen, which is just prior areas of support, prior area of resistance. So it's a level of interest to pay attention to, and it could be very hard to get over that because we also have in confluence with the year-to-date anchored VWAP. So we'll pay attention to that. If you look at the smaller time frame, still wedging, and as you can tell, we did crack below early on underneath the 5-day moving average. Boom, the algos hit. Everyone was like buy, and it started ripping up and closed approximately at the high of day and a high of week. However, the structure is still within a negative divergence, and it's that rising wedge structure. So we'll continue to monitor that, see what plays out. The 5-day moving average as time progresses, if the price floats around in these ranges, this is going to start flattening out and start curling down if price starts getting below it. Okay, so as it stands right now, all these three, still the bulls are in control on the shorter time frames. If we take a look at a couple indicators, starting with the trend indicator, it's getting into that overextended territory to the downside, which could tell us that the market might be in for a period of digestion or a pullback. It's worked multiple times before, the prior times over here, but I wanted to call out, sometimes it doesn't. This is why you get a little dashed line here where the market started to continue to rip up higher, and it really didn't work here too, but it was, got a little pop higher, but then it started getting hit significantly to the downside. So I just wanted to call that to your attention that it is moving into that overextended territory, which could be potentially bearish for the market. From a more bullish perspective, well, our CPC indicator, which is a buy and sell signal, got a reading at 0.86, which is pretty bullish. You can see the 10-period moving average. It's starting to point back down, and when it gets to 0.95, that could indicate a potential buy signal. It's it's always a little interesting to see this while the market already made a strong move. The last two buy signals kind of came quick and fast right here. Bam, we started moving down a little bit, but then it triggered again, and pow, we were off to the races. Very similar right here. It moved up, and then we powed even higher, and then right here too as well. Boom, that was the Santa Claus rally right there. Okay, so this is something to pay attention to where it could indicate that we can have some further upside. The buy signal here, the positive divergence we talked about as the ratio between S&P 500 and TLT put in a lower low, but the S&P 500 put in a higher low, which could tell us that there was more upside. Well, guess what? It started moving up and it was in confluence with some other indicators. The reason why I'm talking about it now is because if you look at the flip side to it today, well, I guess the close of business Friday put in a very, very small negative divergence. Not going to put too much weight on this one because it's so subtle in such a short period of time. I like a little bit more data, but it is still, a negative divergence that if the S&P 500 upticks to 4,200, the divergence isn't there most likely anymore. Okay, so very short-term divergence that's taking place there. If you look at the Saylor to Schiff tool, the Saylor to Schiff tool closed at 8.26% rate of change. Still, it is pointing down, but it is still above the zero line, indicating that we're still on that buy signal. So we'll continue to monitor and see how that develops. If you take a look at a couple BP charts, BPSPX still in overbought territory at 76.55. That's a whopping high number. And then if we continue on the NDX, this one's not overextended, but it did put in a higher high and a lower high. So negative divergence on the NASDAQ 100 BP chart. And if you look at the BP COMPQ, the NASDAQ composite, it is at 82% as this market continues to perpetuate to the upside. Still no digestion yet. Overbought can stay overbought for quite some time, but not the area that I would be too interested in pressing. All right, let's hop into the zones, and I have a couple highlighted over here that we're going to be getting into, a few of them, and I'll bring up the charts and show you a couple of things. This is something that I publish for my Patreon community. This is something that I'm testing, playing around with, learning it. If you aren't familiar with the Patreon, $9 a month. If you don't like subscriptions, I don't blame you. You can pay annually. It's $90 US for the entire year. It's pretty darn inexpensive, and you get quite a bit of stuff. I do swing trade ideas, setups, right? I show them on the daily charts for the most part. I give my watch list in Excel PDF format, which, by the way, a lot of setups are taking place right now. They look pretty good. Which would be the perfect time for a rug pull, is when all the setups start looking very good, and then all of a sudden the market gets hit. Go figure. That'd probably happen. Not banking on it, though. I do like seeing the positive setups happen in various sectors and various charts, so that's a good sign overall for the markets. Expected moves, they track about 31, 30, 40 products, something like that. The spiders, the big tech like Apple, Microsoft, Google, Amazon, Tesla, NVIDIA, AMD, Meta, and Netflix. I give those weekly expected moves. Then you get into the Discord community. I don't post anything on Patreon specifically. If you do this, you got to get on Patreon. Then you got to sync your Discord up. Once you sync your Discord, you get access to the Discord. If you don't have Discord or don't like Discord, then don't do this. All right. So I post everything here on the Discord. I do have an intro video. I think if you go to the link, you'll be able to see the post where I give like the getting started, where I walk through this and what it looks like and what I use the watch list and all that stuff for. The zones. Okay. I highlighted a few here. There's not much going on. I've highlighted a few that have, some fairly big downsides versus upsides, like ARC, XME, XRT, so retailer, financials, and then the IWM. But I want to point out the charts here. You can see IWM is pulling into that year-to-date anchored VWAP. Okay, and that could act as a level of resistance. These red lines, those are the zone that's current. Remember, those are dynamic. They constantly change. So this is moving to the upside of the zone. You have a year-to-date anchored VWAP. You're going into a neutral trend. The short-term is bullish. And then, not to mention, too, if you look at the IV percentile, we're talking 29% is the IV percentile. That's drawn horribly. So a low IV percentile. I mean, if you look at 126 days, right, so a half a year of trading, the IV percentile is at 6%, which basically means the IV, right, we're at 26, which is implied volatility. There's only been 8 days that it's been under that in the last 126 trading days. So how do you interpret that data? This is an easy way to, I always say contraction leads to expansion, all right? Contraction leads to expansion. Well, if you look at implied volatility percentile, it's on a scale of, right, 100% down to 0, right? If it goes, and then the 50 line, if it goes down, right, it's contracting. Volatility is contracting. Contracting leads to expansion, back up. Okay, so chances are we'll see an increase in volatility. At least that's what I imagine in this next week or the week to come. We can see that start to rise once again. That does not mean that it's going to just go down. It means that volatility can increase, right? But that is plus or minus. So you have to take other factors into consideration. Meaning what I'm looking at is you have a strong move It hasn't been digested. Volatility has been kind of contracting. This would be, a potential good short opportunity, in my opinion, just looking at that data. Does that mean that it's going to work out perfectly? No, but I'm trying to put multiple things into consideration. If you look at that gray box right there, that is actually a predicted range, something that I'm working on too as well. I'm testing out. I did just draw the box here, but I actually removed the indicator from the screen because it's kind of messy, and I just drew out what actually it is predicting moving forward based off of the average true range looking back a period of time. So it is signaling a higher high, higher low. The high end is by that year-to-date anchored VWAP. So if you're looking to enter in potentially short, you can start a position pretty much right there at that year-to-date anchored VWAP. And then I'd say, depending on where the zone is, right, it could be another entry right there where you're trying to catch a move to the downside on increased volatility. But there's multiple ways you can play this. You don't need to just short it, right? You can look for spreads. There's like countless unlimited amounts of ways to play it, and or just watch it and see how it plays out, right? That's always an opportunity too. XRT, we're pretty far off the year-to-date anchored VWAP, but I will say, we've been on a strong move to the upside. We're predicting, the range is predicting a higher high, higher low, which brings us to around the upper part of that zone too as well. And then you have, a percentile. It's not crazy low, but it's at 43%, so a subtle discount right there. But if you look at like 126, so a half a year range, you're looking at 6%, which means 8 out of the last 126 days have we been this low too. So that is, getting pretty deep. Contraction leads to expansion. We'll probably see volatility pick up here too as well. If you take a look at XLF, this one has a 27 percentile, which IV percentile is 27%, which means 67 days out of the last year of trading, 252 days, hasn't been that low. So it is a pretty good discount right here on XLF as well. Even on the shorter time frame, 126 days is saying 2 days out of the last 126 days has it been under the current implied volatility of 24. So yeah, like I said, contraction leads to expansion. We'll probably see it pick up. And, we've been consolidating here. That doesn't mean that it has to go to the downside. It could pop off to the upside. All right, that's always a possibility. But when we take a couple factors into consideration, the upper portion of the zone puts us to right around this area, and the lower, so the risk, right, the reward is to the downside mostly, where the risk to the upside, is to the upside. So we'll see how that plays out, but just kind of some insights as to what I'm seeing. And if you take a look at the last one I'll point out is the ARC Innovation, right, ETF, and this is at a 44% IV percentile, which isn't too crazy. But if you look at the 126 days, this thing has been deep and diving over here. So we'll see how that plays out. And we are in this channel that's been kind of just ping-ponging around. The predicted range for going into tomorrow, higher high, higher low. The zone is right up here too as well, with some pretty big downside to the bottom of the channel. So if volatility wants to start, picking back up, it could very well bring us down to the bottom of the channel, or, potentially outside of it, but just be mindful of that year-to-date anchored VWAP. You got to just play it from a risk to reward standpoint. So where's the risk? Where's the reward? There's bigger reward to the downside than there is reward to the upside. So the risk is technically to the up, reward is to the down. And if you look at the overall trends too, medium term and long term, both bearish. But the short term, obviously, we're bullish. We've been kind of fluttering around from neutral to bullish, neutral to bullish, neutral to bullish. So we'll see if that kind of changes here momentarily. But as it stands right now, we're kind of just pressing up. All right, we talked a lot about a lot of things today. That's all I got for you on today's episode, everybody. Hope you're having a wonderful weekend. See ya.